Hello, my name is Justin Sarders and I'm a director at MDA Training. In this session, we're going to have a review of the vanilla derivative contracts, those contracts you might see used every day in fund management. It is a review, so we're going to assume some prior knowledge and that your desire is to bring that knowledge back to the forefront of your mind. We're going to start by having a look at the key features of derivative contract, and then we're going to go on to look at futures, options, interest rate swaps, credit default swaps, and FX forwards. So a derivative is a contract. It's a legally binding agreement between two parties. One of those parties will be the fund, and the other party, what we call the counterparty, will either be a bank like Goldman Sachs or JP Morgan, or it will be a clearinghouse. And the contracts talk about payments. The vast majority of the time, those are cash payments. So we either have the right to receive a payment or we have an obligation to make a payment. And whether we receive payments or make payments is going to be dependent on the price of some underlying asset or index. So for example, if it's a bond derivative, it's going to be based on a bond price. If that bond price rises, the cash flows are going to move in one direction, but if the bond price falls, the cash flows are going to move in the other direction. It could just as easily be a currency, a commodity, an equity, or an interest rate. Two pieces of jargon that we hear used frequently, long and short. Long means that you are the side of the contract that receives cash if the price rises. And short means you're the side of the contract that receives cash if the price falls. So if I'm long a bond contract, my fund will be receiving cash as that price rises. If I'm short a bond contract, then my fund will be receiving cash as that price falls. Once we understand that all derivatives are contracts, then we can start asking sensible questions about any new derivative that we come across. For example, who's the counterparty? Is it a clearinghouse or is it a bank? What is the contract based on? What's the underlying? Is it an interest rate? Is it a bond, a commodity, an equity, a currency? What's going to drive the direction of the cash flows? How are the payments going to be calculated? Is it a percentage of a nominal amount, or perhaps is it a value for each individual point that the price moves? And when are the payments made? How frequently is that going to happen? With some contracts, it's every single day. With other contracts, it might be every 3 months or 6 months. And sometimes with some contracts, it's only when that contract finally matures. Now let's take a look at futures contracts. In particular, commodities and bonds. We're going to start with gold because gold is easy. The price here of an ounce of gold is $1,301.7 per ounce. If we were long this contract, we're going to receive cash as the price of gold rises. Each time the price of gold rises by $1 or 1 point, for example, if it went to $1,302.7 an ounce, we will receive $100. If the price rose by 5 points, we would receive $500. If the price fell by 2 points, we would have to pay $200. And these cash inflows and outflows will happen every single day. And they happen through a margin account. At the beginning of the contract, when we enter this contract, we have to ensure that we've got $3,410 deposited in our account. How do we get into the contract? Well, futures are exchange traded, and that means we place an order on the exchange to enter or exit a contract. In this example, we wanted to be long, so we place an order to go long on the exchange. If somewhere in the world there's a party B that wants to go short, they place an order to go short on the exchange, and the job of the exchange is to match those two orders. If nobody wants to go short, our order will come back unfilled. But assuming it has been filled, then we need to ensure that we've got money in our margin account, and we start with $3,410, and so does B. If the price of gold then rises by $1, we will receive the value of a point, which for this contract is $100. And the value on our margin account is now 3510. Of course, the balance on B's margin account has dropped. They had to pay away $100. And these cash flows will move in and out every single day until either the contract matures or we close out the contract. To close the contract, we would place another order to go short. And if that's filled, our contract is now closed out. Here's another example. This time it's for a German government bond. It's worth noting that you only get futures contracts for government bonds, not corporate bonds. Here, the price is 156.56 and the value of a point is 1,000 euros. So every time that price moves by 1 point, we're going to either receive or pay 1,000 euros. And remember, the calculations are being done every single day and the cash flows are happening through our margin account. So how might we use a future in fund management? Well, if we have a bond fund and bond prices are rising, of course the unit price is doing well. If we think bond prices are going to continue to rise, we can add some exposure to our bond fund by also going long a bond future. That way, as bond prices do well as they rise, we make money on the bonds, but we're also receiving cash on the bond future. We would use the word duration. Duration means exposure to the bond markets. We've now got more exposure. As the bond markets rise, we make more money than we would have done before. Of course, if the bond markets fell, we would end up losing more money than we would have done before. We can also use these futures contracts to hedge. Let's say, for example, that we think bond prices might be falling. We're going to see the value of our bond fund fall. Well, by going short a bond future, we can help hedge that happening. As bond prices fall, we lose money on the bonds, but we will be receiving cash on the bond future to compensate us for those falls. We have less exposure to the bond market, and we might say we have a shorter duration. Now let's have a look at options, in particular currency and bond options. You may remember a call option is the right to buy an asset and a put option is the right to sell an asset. The transaction will happen at the strike price, that's in the contract details, and the contract expires on the exercise date. If you can exercise the option at any time up to that date, it's called an American style option, and if you can only exercise the option on that date, it's called a European style option. And there's a premium exchanged. The option buyer or holder has to pay the option seller or writer a premium. It is a legally binding contract and cash flows happen between the two parties. So at the start, the option buyer will pay the premium to the option seller. Whoever pays the premium gets to choose whether this transaction happens, whether the strike price is paid to receive the underlying asset, and that's only going to happen if the underlying asset is more valuable than the strike price. Otherwise, why would the option buyer choose to do that? Let's have a look at this currency option. It's a call on the pound, or if you prefer, a put on the dollar. But it's the right to buy pounds for dollars, and the strike price is 136.22. It's the right to buy £1 million at that rate in 3 months' time. We've got to pay a premium if we are the option holder of 59.7 points. Now, 1 point in the currency markets is 1/10,000th. So if you look at that 1 million notional, 1/100th of a million is $10,000, and 1/100th of that is $100. So every point, the fourth decimal place, like the 2 there, is worth $100. So this is going to cost me 59.7 points, in other words, $5,970. Now, if the pound strengthens, I'm going to be able to buy these pounds at 136.22. If, however, the pound was to weaken, then I can just go into the market and buy the pounds at the lower exchange rate. If it fell to 134, I could just go into the market and buy them at 134. So what this option is doing is it's capping the price that I will have to pay to buy pounds. Let's have a look at another option. This time it's for German government bunds or German government bonds. It's a call option. It tells me down here it's a call, but also in the ticker, that C means call. And the strike price up in the ticker is 159.50. I'd have to buy the option. It would cost 0.33 points. And it's structured in the same way as the future. So 0.33 points, 0.33 of 1,000 euros is 330 euros. So if the value of German government bonds were to rise, let's say up to 160 or 165, I get to buy them at 159.50 and I'm going to enjoy a gain in the fund. The fund is going to do well because of that. If, however, I'm wrong and German government bonds fall in price, then I'm not committed to buying those German government bonds and I don't suffer that loss. What I do suffer is the loss of 330 euros. That's the premium, and that's the most I can lose. For a put option, we have a similar life cycle. So the option buyer pays the option seller a premium, and this time the option buyer or holder gets to choose whether to receive the strike price for delivering the asset. Now, they're only going to do that if the value of the underlying asset is less than the strike price. In other words, if the prices have come down. Put options are going to get exercised when prices fall. So let's have a look at a put option here on German bunds. It's a put option. It says P there in the ticker, and it also says put down here in the description. The strike is again 159.50, and the price, the premium, is 0.57 or 570 euros. So this is going to protect me against the price of my government bonds falling. If I've got government bonds in my fund and they were to fall below 159.50, I'm going to be able to use this put option to put a floor on the value of those bonds. In a sense, I can sell them at 159.50. Now, people like to use hockey stick diagrams or payoff diagrams to describe what's happening. Here I've used nice round numbers. The strike price is 160 and the premium is 1. So it's similar to the Bund options that we saw just a few minutes ago. With a call option, if the price rises above the strike of 160, then we will exercise the option and make a profit. So for example, if the price got up to 162, we would be able to buy the bunds for 160. They're worth 162. We've made a profit of 2. However, the premium is 1. So our net profit, 2 minus 1 is 1. If, however, the price was to fall, let's say down to 158, which would be down here. Remember, the strike is 160. So 158 is down here. Then we would buy those bunds in the market. We wouldn't use the option. The option would expire worthless. And we have lost our premium of 1. So we make a return from the call option as the price rises, but we've got a limited downside if the price falls. With the put option, it's the other way around. We get a return from the option if the price falls. So if the price was to fall, let's say to 158, what does that mean? It means if I didn't already own the bonds, I could buy them in the market for 158. I could sell them for 160, making a profit of 2, less my premium of 1, is a net profit of 1. If, however, the price of bunds rise, then I would just sell them in the market rather than using the option. The option would expire worthless. And what have I lost? I've lost my premium of 1. So I make money on this put option as the price falls, but my losses are capped if the price rises. The most I can lose is the premium. This is the position of the option holder, and on the next screen we've got the position of the option seller. If I sell a call option, I receive a premium. So I receive 1, that will be my profit. However, if the price rises, then I am forced to sell my bond at a low price, at the strike, when the actual price is, or the market price is higher, and I will suffer a loss. So if you're an option writer, you receive a premium, you've got limited upside, which is the premium, but you potentially got a lot of downside. Similarly for the option writer for a put, your upside is capped at the premium that you receive, but you potentially got quite a lot of downside. So what you will see is that when people are buying options, it's generally about limiting the downside. That's the benefit. Why would anybody sell an option? Well, the answer is to receive the premiums, and normally the strategy is something to do with income enhancement or generating income for the fund. Now we're going to look at interest rate swaps. Interest rate swaps are a contract between two parties, and this time there are two cash flows. They're both based on interest rates. One is a fixed rate of interest. It's going to be a fixed percentage. Let's say it's 3%. And the other rate of interest is going to be a floating rate. And quite often it will be LIBOR. It could be 3-month LIBOR, 6-month LIBOR, but typically it's based on LIBOR. And to calculate the cash flows, we're going to take those percentages of some nominal amount. So for example, if the fixed percentage was 3% and the nominal amount was 100 million, 3% of 100 million is 3 million. And if LIBOR was 1%, 1% of 100 million would be 1 million. So those would be the cash flows that we would exchange. These swaps typically last for a number of years. 2 years, 5 years, 10 years, even 30 years are all quite common. Now, they are used to take a view on the direction of interest rates. So, for example, if you thought that interest rates were going to rise, you'd want to receive the floating rate, receive those higher interest rates in the future. However, we refer to the two sides of the swap by the fixed rate. So if you think interest rates are going to rise, you want to be on this side, on the red side, receiving the floating, but we would say you're paying fixed. You think interest rates are going to go up, you want to pay fixed and receive floating. If the fund manager thinks that interest rates are going to go down, they would like to keep receiving the same fixed rate, but pay a lower and lower and lower floating rate. We would say they want to be receiving fixed and therefore paying floating. Here's another diagram illustrating how an interest rate swap works. This one's based on 100 million again. This time it's a 2-year swap, and on the fixed side it's 4% semi-annual. So 4% is for the year, it's semi-annual, 2 payments a year, and that means it's going to be roughly 2 million every 6 months. And we can see every 6 months we have these cash flows of 2 million. On the floating side, this swap must have run its course because we've seen what LIBOR has been through the term of the swap. 6-month LIBOR was 3.6% for the first fixing. So for 6 months, we're going to divide that by 2 roughly. That's 1.8 or 1.8 million. The next fixing is 3.8%. Halving that gives us 1.9, then 2.1 and 2.3. Now, these nominal amounts or notional amounts of 100 million are never actually exchanged. So I'll put them on the diagram just so you can see what they are. In reality, the cash flows are netted. So if I need to pay you 2 million and on the same day you need to pay me 1.8 million in the same currency, we'll net those off and I'll just pay you the difference of 0.2. Let's have a look at a real swap. The first one is for US dollars. On the left-hand side, you've got all of the details of the fixed leg, and on the in the middle, you've got there all of the details of the floating leg. Both legs have the same notional, which is common, 10 million. Both legs are in US dollars. They could be in different currencies. Here they are in the same currency. And the swap has a term of 5 years, running from 2018 through to 2023. Now, on the fixed leg, we can see the fixed rate is 2.916300%. On 100 million, that's going to be about 291,000 every year. It's semi-annual, so roughly half of that, about 145,000 every 6 months. On the floating leg, it's based on US treble 3M, which I happen to know is 3-month LIBOR. Because it's 3-month LIBOR, the payments are actually going to be quarterly. And the latest US dollar LIBOR fix for 3 months is 2.35%. Now, the value of the swap initially is 0, and you can see that down the bottom here. The NPV is 0. If, however, we were receiving fixed, which we are with this swap, we're receiving fixed and paying floating. We will do well if the floating rate falls or at least stays low. So we're going to receive 291,000 a year, paying away at the moment 235,000 a year. As long as that situation continues, we're going to do well. If, however, the LIBOR was to rise, particularly if it rises up above 2.96, then we're going to receive 291,000. We're going to be paying away more than that. Then we're going to start to do less well. So we want interest rates to remain low, and we're going to have to start paying away cash if interest rates were to rise. Every time interest rates move by 1 basis point, the value of this swap is going to move away from its current net present value of 0. And every time it moves by 1 basis point, the value of the swap is going to change by $4,677. That's called the PVO1 or DVO1. There's a slight difference between those two. It's a very technical difference. It's exciting for me as a mathematician, but not exciting for anybody that's a practitioner. The difference is 2.5 cents on a $10 million swap. All right, so there's a real US dollar swap. Now we're going to have a look at one for the euro. This is rather interesting because interest rates are negative for the euro at the moment. The fixed side is minus 0.14%. We are receiving that. Now, if you receive minus 0.14%, that actually means you're going to be paying. All right, so although it says receive fixed, it means we're going to receive a negative amount. We're actually going to have to pay on the fixed side. But on looking on the floating side, we've got to pay away minus 0.269%. That's the latest LIBOR fix for 6-month Euribor. Now, if you're paying a negative amount, the good news is you are receiving interest, receiving cash. So rather interesting there with those negative interest rates. The cash flows are both moving in the opposite directions to what you might expect. Again, the NPV is 0, as we normally see for a swap when it's first initiated. This swap has a smaller DVO1 and PVO1, and the reason for that is this is a 2-year swap, and our previous swap was a 5-year swap. If you want to estimate the PVO1, if you look at 1 basis point multiplied by the term of the swap, so 1 basis point times 2, because it's 2 years, multiplied by the notional of the swap, which is 10 million, that's 2 basis points on 10 million, which is 2,000. That will give you roughly the DVO1. For the previous swap, 1 basis point times 5 years is 5 basis points times 10 million is roughly 5,000 for the DVO1. So we can use these swaps to help manage interest rate risk in fixed income portfolios as interest rates and bond prices move in opposite directions. If we think interest rates are going to come down, we think bond prices are going to go up, and vice versa. So here's a cheat sheet for us. If we think interest rates or yields are falling, we think bond prices are rising, we would like to increase our exposure to the bond market, in other words, increase our duration. We can do that by buying bonds. We can also do it by receiving fixed and therefore paying floating when the rates are falling, paying floating on an interest rate swap. That will increase our duration. We could buy bond futures, and we could also buy interest rate futures. If we think that interest rates or yields are rising, in other words, bond prices are falling, we want to have less exposure to the bond market. We could do that by selling bonds that we own. We could also do it by paying fixed and receiving floating on a swap. Remember, interest rates are rising, so we will benefit by receiving floating. We could sell bond futures, taking the view that bond prices are going to fall. And we could also sell interest rate futures. Our next derivative is a credit default swap. Credit default swaps are like a type of insurance. There are some differences to insurance. With insurance, you have to have an insurable interest. You have to prove that you've suffered a loss before you can make a claim. However, with a credit default swap, you can make a claim even if you haven't suffered a loss. So what is it that you're insuring? You're insuring against a default either by a company or actually also by a sovereign nation. You're insuring a particular bond against a credit event, and that credit event could be default on a payment, it could be going into liquidation. You're insuring a certain notional amount of bonds, and for that insurance you're going to have to pay a premium. So how do the premiums work? Well, there's two parts to the premium payments. There's an ongoing payment that we're going to be making quarterly, but it's expressed on an annual basis. And for investment grade issuers, that's 100 basis points a year. And for high yield issuers, it's typically 500 basis points a year. There's also a payment up front, which we'll call points up front, and we'll see fairly shortly. If there's a default, then the claim can either be physically settled or cash settled. If it's physically settled, you hand over the defaulted bonds, which in our example, we're saying are worth 40 pence on the pound or 40 cents in the dollar, and you receive 100 or par back in cash. So you're made whole. If it is cash settled, then you just receive the difference between 100 and the post-default price, let's say 40, in cash. So if the bonds default and they're then trading at 40 post-default, you would make a claim for 60. And that's how you would be made whole. Here's a real credit default swap on a retailer called Sainsbury's. And we can see what the cash payments we would need to make are. We can see the coupon is 100 basis points. That's the annual payment. It's actually made quarterly, so it'd be roughly 25 basis points a year, and the notional amount is 10 million. So 25 basis points on 10 million every year, that's 25,000 a year. However, we've also got points up front. As you can see over here on the right, it's 0.278891110, and that would amount to nearly 28,000 that we would need to pay up front. So it's 28,000 up front, and then 100,000 a year for 5 years. Now, if you worked out what the total amount payable would be, it would be 5 lots of 100, that's 500, plus the 28, so about 528 in total. And if you were to divide that by 5, because it's a 5-year swap, it's running from 2018 through to 2023, so 5 years. If you were to divide it by 5, you would come up with roughly 105 points per year. Now, this is called the spread. This is often what we hear about when we're talking about CDS. We're saying Sainsbury's is trading at a spread of 105.62 points. That's not a cash payment. It's the average cost of this CDS, made up of the points up front together with the running coupon. Now, it is possible, if the credit quality of the organisation is a little bit better, which we see for Tesco's, for the points up front actually to be negative. So here, what are the payments? Well, it's 100 points a year. That's 100,000 a year, or roughly 25,000 a quarter, every year for 5 years. It's a 5-year contract once again, and 5 years is the most common term for these credit default swaps. However, the points up front is negative, meaning that when we take out this insurance, this CDS, we actually receive 0.156% of 10 million. That's roughly 16,000. So we're going to receive 16,000 to start with. Then we're going to pay 100,000 a year each year for the next 5 years. If you add all of that up, it's 484,000. 500,000 minus 16, 484. Divide that by 5, and you're coming out at roughly 96 or 97 points per year. So that's the CDS spread. Now, we do have single name CDS, but we also have index CDS, and the most common is called iTrax here in Europe. It is a CDS contract based on 125 names in Europe for the main contract, and they would all be investment grade names. For this contract, we're paying, because it's investment grade, 100 points a year. However, we receive 2% up front. All right, so if you think about, you're paying away 100 points for 5 years, that's 500 points, but you receive 200 points up front, you're paying away about 300 points. Now, that averages out to around about 56.93 points per year. It doesn't work out precisely when you do that division, because you've got to take into account the fact that some cash flows are later and some cash flows are earlier, and that impacts the value of those cash flows. And you might have heard about time value of money. That comes into it as well. But roughly, that's what we're looking at. So if I want to insure a single name, I can do that with single name CDS. If I want to protect a portfolio of credit holdings in the fund, then I can do that with index CDS. I can buy CDS, which means I'm buying protection. I'm hedging against defaults in the fund, or I can sell CDS. That means I would be receiving the premiums. I would be increasing my exposure to credit, but I would be enhancing the yield of the fund from those premiums that I'm receiving. So here's a question for you to think about for a moment. You gain exposure to a company's credit quality and earn a return by buying the bonds. I buy the bonds, I like the company, I get exposure to the credit, and I earn a return through that. How would I do the same through using CDS? Well, the answer would be B, by selling CDS. If you sell CDS, you earn a return, but you get exposure, you are exposed to the company defaulting. So if you're buying bonds, the equivalent is selling CDS. Our last contract is an FX forward. FX forwards are commonly used to hedge exposures to overseas currencies. In this example, our fund is denominated in the euro, but we have a holding in US dollar bonds. We've bought $114 million worth of bonds, and the exchange rate is currently 1.14. So in euros, that would be 100 million euros. The fund manager is going to be worried about the dollar weakening or the euro strengthening. And therefore, the hedge is to buy euros and sell dollars. The notional in euros that we need is 100 million. Now let's see what happens as the markets progress over time. Well, the good news is bond prices in the US have risen by 5%, and so our bonds are now worth $119.7 million. They've gone up in dollar terms. However, the euro has also strengthened, in this case by 10%. The exchange rate is now 1.2540. So when we convert that $119.7 million into euros, it's actually only 95.45 million euros. So in dollar terms, we've made money, but in euro terms, we've lost money. Now, luckily, we've also struck a forward contract to buy 100 million euros for $114 million. So we can go ahead and do that. Pay $114 million for 100 million euros. The exchange rate is now 1.2540. If we were to exchange those euros for dollars, we get $125.4 million, making a profit of $11.4 million. Our last contract is an FX forward. FX forwards are normally used to hedge exposures to overseas currency. Here, we've got a fund which is denominated in euros, but we've got a holding in US dollar bonds. We bought $114 million worth of bonds. The exchange rate is 1.14. So in euros, that would be 100 million euros. We are worried about the dollar strengthening. Our last contract is an FX forward. FX forwards are normally used to hedge exposure to overseas currencies. Our fund is denominated in euros, and we have a holding in US dollar bonds. We bought $114 million worth of bonds. The exchange rate is 1.14, and that's equivalent to 100 million euros. We are concerned about the dollar weakening or the euro strengthening, and therefore we should buy euros in the forward market to hedge. And we should buy 100 million euros in the forward market. That will be the notional. Now, over time, the bond price has risen by 5%. Our bonds are now worth 119.7 million euros. However, the euro has also strengthened and the exchange rate is now 1.2540. So although the bonds are worth more in dollar terms, they're actually worth less in euro terms. We've suffered a loss because of the exchange rate movement. However, because we've done the forward contract, we've hedged that loss. Let's see how that works. We contracted to buy 100 million euros for $114 million. The exchange rate was 1.14. In today's market, those 100 million euros are worth $125.4 million. That's a profit for us of $11.4 million. And if we were to express that in euro terms at today's exchange rate, that's a profit of 9 million euros. So our bonds are worth 95.45 million euros. Our forward contract has made us 9 million euros. In total, our fund, the holdings together, are worth 104.55 million euros. So we've actually made a gain of 4.55 million euros. We haven't made quite the 5% that we saw the bond price move by. And that's because it's very difficult to get a precise hedge. To get the hedge precise, we'd actually have to know that the bond price is going to move to 119 and hedge the 119 rather than 114. So these currency hedges are never a precise science. You can't get the hedge absolutely precise, but you can do pretty well with it. So we've looked at a whole range of contracts and we've talked about a number of different things that we can do with them. In summary, we can use derivatives to take views. Is the market going to rise? Is it going to fall? Perhaps is it going to become more volatile? We can use derivatives to hedge against market movements. And we can also use derivatives to actually enhance income. For example, by selling CDS contracts or by selling or writing call or put options. I hope that's been a useful review for you. And I look forward to seeing you again soon.